Welcome to Technical Tuesdays. This is Fred Razak, Senior Trading Strategist here at CMTrading. And today we're going to be discussing interest rates. So before we start, make sure to like and subscribe so you can get future content like this. Okay, so interest rates are what makes money either go higher or lower. It's an interesting relationship that interest rates have. And the reason I'm talking about this specifically today is because tomorrow we have an FOMC rate statement, which means that the central bank in the United States is going to come up with their interest rate decision for the first time in 2023. Now, over the past year, they've increased interest rates really to stem off inflation. So giving you a little bit of a background about this technicality of interest rates and how the money supply affects the market. So it's very simple. When money is expensive, okay, people are less likely to borrow it. When money is cheap, people are more likely to borrow it. Okay, so it's a very simple situation. And this is how one of the ways that central banks really control the flow of money into the market and out of the market. And it's a very interesting way that has been done since the 1920s, actually, since the collapse of 1929, the setting up of the SEC, the setting up also of the central bank in the United States, the Federal Reserve, and that has what propelled us to modern day financial system. Now, this system is economic based somewhat, okay, a lot of math into it, a lot of economic math that goes into it, but some of it is also, the feeling and the data that is coming out. Now, when these central banks make the decision as to increase interest rates or lower interest rates, one of the factors is either inflation or deflation. Now, inflation is basically the value of money being diminished, okay? That's what it means, okay? What cost you before to buy a can of soda, for example, was, let's say, 3 Rand. Now it's about 5 Rand. So the money has actually devalued, that the product is more expensive, but the money costs more money to buy that same product, okay? And inversely, if, for example, the prices actually goes down, okay, if the price of soda was to go to, let's say, 2 Rand from 3 Rand, now you have 1 Rand in your pocket. That means your value of the currency has actually gone increased, okay? So why do we do this? Okay, so there's inflationary concerns that have hit the market, mostly because of either geopolitical or economic things that have affected the markets, namely the price of oil going so high last year, okay, as it went to about $140 a barrel, okay, spiking to that level overnight. And it did correct itself, but the market plays catch up. Once that happens, the market starts increasing prices, for goods and services because it costs more for those goods and services because the price of oil is more expensive. As a result, there creates a place of inflation. Now, in order to stabilize that, the central governments make it more expensive to borrow money, right? So before, when it costs you to, let's say, borrow 100,000 Rand would cost you, let's say, 15,000 Rand a year or 5,000 Rand a year. Now it'll cost you about 30,000 Rand a year. So that same 100,000 Rand that you're borrowing would cost you 15 to 20% more expensive. You're going to be less inclined to using that money or to borrowing that money, thereby decreasing, the supply of money in the market. So it's a very interesting way where markets are actually being subdued in order to make money more expensive so that it doesn't devalue. And it's a very simple concept, and then the markets really react to it. The markets don't like uncertainty, but at the same time, if there's a devaluation of the dollar, so the market is going to devalue as well. So the prices are going to go higher, but it's going to be a fictitious going higher because it's only because of inflationary reasons that the prices are going higher, not because the companies are making more money. So it's a very interesting environment that we find ourselves in. Tomorrow night, Wednesday, February 1st, at 9 p.m. South African time out of the United States. We're going to have an FOMC rate statement. It's going to rattle and shadow the markets up or down in either direction. It's always been a tremendous impact on the market since as far as I can remember, for as long as the markets have been around. And I think that it's something that you do need to know about it. And the more you're aware about it, the more you can react to it as well. Thank you. We'll see you here next week on Technical Tuesdays. God bless everybody.